Hello and welcome to this SRA webinar looking at the changes to the reporting accountants regime. My name is Sean Hankin and I'm a Forensic Investigation Team Manager. I'm also a Chartered Accountant and have been involved in the development of the changes we will be discussing today. I also have responsibility for overseeing the review of all qualified accountants reports that are received into the SRA. I'll now hand you over to my colleague, Amanda Norton.
Hello everybody, I'm Amanda Norton and I work as a Regulatory Manager at the SRA. I'm a Chartered Accountant and I've been involved in the development of the changes we'll be discussing today. Before we get into the detail of the changes to the reporting accountant requirements, I thought it'd be helpful to run through the format and structure of the session today. Sean and I will talk you through the changes and you should see the slides as we do so. That should take up to half an hour. We'd like to give you plenty of time to ask and answer questions, as we know this is a big change and for all concerned. To make sure you're all still listening, we have some interactive voting slides throughout the webinar, which we'll ask you to vote on as we go through, and it will be interesting to see your reactions in real time. At the end of the slides, we'll take a 2-minute break, and then we'll reconvene for questions and answers until the session ends. We'll also be asking for your feedback, and this will appear before your very eyes at the end of the session. The webinar will be available to listen to again on demand, either on the events part of our website and also on your YouTube, if you have colleagues who haven't been able to listen in live, and that will be available in a couple of days' time. So before we get into the detail of the changes, I want to set the scene so you understand the context in which these changes are being made. Having moved to outcome-focused regulation and having had the handbook in place for a few years, we're now reviewing our regulatory framework to check that our regulation is properly targeted and proportionate. The accounts rules is a key set of rules aiming to secure the safety of client money, and it's part of a package of measures that aim to achieve client protection. Some of the measures that we're looking at that deal with client protection are consultations on PII, which of course is professional indemnity insurance, the compensation fund, and alternatives to client money, and that's third-party managed accounts, such as used by the bar. The changes have been arrived at after significant engagement with the accountancy profession, the institutes and other membership bodies, including the Law Society and ILFM. And we'd like to extend our thanks to all of those of you who are listening, who gave your time to us, and we very much hope that we'll be able to continue that engagement as we move forward with our further review. In 2014, we began a discussion on the risks posed to client money, the difficulties with overly prescriptive rules, and our planned regulatory response. We set out a 3-phased approach to reform of the accounts rules. Phase 1 was completed in October of 2014, when we removed the requirement for firms to obtain an accountant's report where 100% of their client money is received from legal aid agency work, which affects about 120 firms. We also removed the requirement to file unqualified reports with the SRA, so we should now only be receiving qualified accountants' reports. Phase 2, which we're discussing today, will remove the requirement to obtain a report for low-risk firms who hold small volumes of client money, and will also remove the prescriptive approach we imposed on the reporting accountant when assessing compliance with the rules. We'll come back to the detail of these changes and the impact on firms in the next few slides. These measures together begin to remove unnecessary regulatory burdens on firms and help us move to a more proportionate approach to keeping client money safe. However, as we set out in our policy statement last year, a more significant review of the regulation is needed, the aim of which will be to reduce the length and complexity of our rules and to give consideration to alternative approaches to handling client money. That review will comprise Phase 3 of the reform, which we'll look at in the final slide today. Now I'm going to hand over to Sean.
In 2014, we consulted on our Phase 2 changes between November 2014 and January this year, which included the proposal to remove the detailed and prescriptive requirements in the rules about what the reporting accountant has to do in all cases to prepare his or her report. Over 4,000 qualified reports are returned to us each year for a range of reasons, but the vast majority are for only minor breaches. These include short delays in posting money to the client account, or wrongly posting a payment that is promptly corrected. Or my particular favourite from when I used to review all the qualified reports myself was office money retained in client bank account for longer than 14 days. Our experience has been that many of these qualified reports do not reveal any significant risk to client money. And just to back that up, in the past 12 months, we've probably taken regulatory action in only 10% of the cases where reports are qualified and submitted to us. Following your responses to our consultation and support for changing and moving away from the prescriptive approach to reporting, we are removing the detailed requirements in the rules as to the one-size-fits-all approach. In the future, more flexibility will be given in enabling reporting accountants to determine the types of work that they, in conjunction with firms as necessary, are required to undertake in each case. This will depend on a number of factors, including the size and complexity of the firm, the nature of the work undertaken, the number of transactions, and amount of client funds held. For year ends of 1st of November 2015 or later, reporting accountants will be asked to exercise their professional judgment in completing their report to help ensure that only when client money is at risk or there are serious breaches that reports are qualified and submitted to the SRA. We listen to calls for the need to ensure a consistent approach and, in collaboration with stakeholders, have developed guidance for reporting accountants, including best practice to assist firms in benchmarking their accounting processes and in making improvements to protect client money. Our proposals also included a recommendation to remove the requirement to obtain an accountant's report from categories of firms that pose a low risk to client money. The majority of stakeholders agreed that holding low levels of client funds would not pose significant risks, and after carrying out an analysis of client money information supplied as part of the practicing certificate renewals exercise, we therefore decided that firms that have both a £10,000 average client balance or less and a maximum balance of £250,000 or less should be exempt from the requirement to have an accountant's report. We decided to include the upper maximum to capture those firms that seldom do transactional work, but when they do, the amount of client funds held and therefore potential risks may be significant. We can't say that these firms pose no risk to client money, but we are confident that the risks are sufficiently low to allow us to remove the cost and regulatory burden for these firms. We estimate that this will benefit approximately 13% of firms that currently hold client money. Apologies, the slide seems to have skipped on there for some reason. So how will this work in practice? During the accounting period, a firm must obtain reconciliations of the statement or passbook balance of the general client account and associated accounts, as defined in the rules. These reconciliations must be taken, as a minimum, at least every 5 weeks. Based on the multiple reconciliations taken over the accounting period, the firm must establish, firstly, the average client money balance, as calculated by taking the sum of all reconciliation balances and dividing this by the number of reconciliations. And secondly, the maximum of these reconciliation balances. If, based on those balances, a firm satisfies both of the exemption criteria, it will not be required by the SRA to obtain an accountant's report, unless advised otherwise. So, for example, we could, under Rule 32.2, require firms to submit reports regardless of how much money they hold in client accounts. The other exemption, of course, is when a firm is ceasing to hold client money, and we will always require a report in those cases, whether or not there have been breaches. Details of how to calculate whether a firm is exempt will soon be able to be found within a document, a frequently asked questions document, which will be published on our website sometime next week. The exemption will only apply for accounting periods ending from 1st of November this year onwards. If your last accounting period ended before that date, then you will still be obliged to obtain a report in relation to that period in the usual way. So I think you've already had a sneak preview of the question that we're going to put to you now. It's a fairly simple question. We're asking whether this new approach, whether you feel this new approach will enable you to provide greater value. So I realise we have some coffers listening in today, and we also have some reporting accountants. So if you're a coffer, do you think that the changes will enable you to get more from your accountant's reports? And if you're a reporting accountant, do you feel this will enable you to provide better value for your solicitor clients? So we'll open up that vote now and wait to see the results. So we'll give you a few seconds to register your votes. Hopefully it works.
I'm looking forward to see the results here.
We believe the increased ability to get better value from your accountants using their judgment rather than the prescriptive checklist approach will hopefully be of benefit. So we close that off there?
Yes, okay. So we're closing off the voting now, and you should be able to see the results. So that's good. That's very reassuring. So we've got 68.9% of people think that this will benefit, and 31.1% who currently don't. Hopefully by the end of the webinar, we can change some of those views. Okay, so we'll have another couple of votes like that as we go through the webinar. So it really is very helpful to see what people think live. Okay, so we're just waiting for our next slide to come up on the screen. Okay, well, whilst we wait for that to come up, I'm going to be talking to you about the timeline of changes. So, the consultation closed on the 28th of January this year, and we sort of refined what we wanted to do, and our board, the SRA board, agreed those changes in July. And we received LSB Legal Services Board approval of those changes on the 2nd of September, which gives us the green light to proceed with the changes to the rules, which will come into effect from the 1st of November. But as Sean has already mentioned, those changes will be for accounting periods, year ends, ending on the 1st of November onwards. So I think Sean has already outlined what that will mean for law firms, changes for law firms, but we're conscious that we have a number of reporting accountants listening in today, I think it's useful just to go through what the changes will mean for reporting accountants, and clearly there's an impact there for law firms as well. So for reporting accountants, when undertaking work for a year end in November and onwards, we have removed the restrictions on your work and instead are asking you to carry out a work programme with your law firms that focuses on client money risk. Where you find breaches of the rules, we ask you to consider whether those breaches represent a serious risk to client money. And if you think that they do, then please qualify the report for submission to us. And we're also asking you to consider whether, in your view, the systems and control environment is sufficient in the context of the firm to protect client money. And if you don't think it's sufficient and represents a material risk, then qualify the report for submission to us. We've produced some guidance that illustrates what we feel represents good, average and poor control arrangements. And this is intended to help accountants as well as law firms. And I'm going to be talking through the content of that guidance in a moment. And just to reiterate, there is no change whether you're exempt or not to cease to hold reports. So where you cease to hold client money, you must obtain and deliver a report, even if you've been exempt previously, and the report must be delivered whether it's qualified or not. So we do recognise that this is a change to long-established practice, and you can find the new AR1 form and the guidance that I've just referred to on our website. That's in sort of Word document form currently. We're in the process of making that usable sort of working documents and forms that you can download, and those usable forms going forward will be available towards the end of next week. On the website address there, that's www.sra.org.uk/guidance. That's where you'll be able to find those workable documents from next week. We're also in the process of developing some further guidance, frequently asked questions, and more detail around how to calculate whether or not you're exempt. And again, that documentation guidance will be available towards the end of this week. If you have any further queries in due course, having read the guidance, then please contact the contact centre, as again the details there on the slide. So I just thought it'd be helpful now to sort of talk through the new AR1 and then the new guidance, just to draw to your attention to some of the key changes. So the new AR1 form, it's much reduced in size. It's now 3 pages long. But what we've done is we've set out on that form what are the key accounts rules that we're asking reporting accountants to do their work against, and then asking for qualification and therefore submission to us if there are material breaches against those key accounts rules, and or if there are significant weaknesses identified as part of carrying out that work in the systems and controls around the compliance and the control of client money. So those are the sort of the key changes there for the reporting accountant's perspective in terms of the form itself. The guidance is quite a reasonably lengthy document, and we've attempted to put in one place a variety of different things, and we've tried to design this guidance to be of use to both reporting accountants and also to law firms, particularly for coppers, to give an illustration both of what we're seeking to achieve with these changes, but also to provide guidance about what we regard might be material events that would require either qualification and submission to us by the reporting accountants, but might also represent something that coppers might regard as material and which we might expect to be reported to us in accordance with COFA's duties as set out in our authorisation rules. So just talking through that guidance, there's a number of different sections that I want to make you aware of, and strongly recommend that you have a look at, as well as the next few weeks to familiarise yourself with. So there's an introduction. I think it always helps to start at the start. So the introduction deals with the background to the changes, talks about how reporting accountants might like to go about planning some of their work with law firms, draws attention to risk factors, and also stresses the importance of scoping and planning work in the context of the law firm. Proportionality, remember, is very important to us here at the SRA. Section 1 sets out the key rules that we require reporting accountants to assess compliance with, and those are the rules that we think are particularly relevant to the safety and security of client money. Section 2 sets out what we have termed serious factors and moderate factors, which might are more likely or less likely to lead you to conclude that there's a material breach that needs the report to be qualified and hence to be submitted to us. So some of those serious factors that we think would lead towards a definite qualification are, for example, a significant or unreplaced shortfall on client accounts, or evidence of willful disregard for the safety of client funds.
Client account users, banking facility, that's a good one to have in there. Yeah.
We've also got in there actual or suspected fraud or dishonesty, no accounting records. So you can see the sorts of things that we're looking at there as representing something that would require qualification. And then things that we've got in as moderate factors might be material breaches that haven't been reported to us within a month of identification, for example, or accounting records being insufficient or unreliable, or perhaps three-way client account bank reconciliations not being regularly carried out. Those are some of the examples of what we think might be moderate factors. I think, as we'll all be aware, the nature of law firms varies tremendously, and so we're asking accountants to continue to use the judgment that you've already been applying around determining whether or not something in the context of the firm that you're dealing with is material or not. And then within the same document, in our section 3, we've set out in a sort of traffic light system examples of what we think are good, average and poor controls and systems that you might find in place at law firms in connection with client money. And those are also linked to the key account rules that we're asking you to look at. So we've given some suggestions of the sort of work that reporting accountants might like to do around those key areas. But also we've tried to, as I said, provide illustrations of what would represent good practice, average practice and poor practice, so that firms themselves can have a look at that and COFAs can have a look at that and sort of give yourself some benchmarking against what our experience is, having regard to the profession as a whole. Always bearing in mind that we're not being prescriptive about this. This is just guidance and seeking to provide some illustration. So we're not at all saying that every reporting accountant has to do all of this work for every firm. And some reporting accountants might decide that they can do considerably less than what we've outlined in this document, and some may decide that actually, because of the scale of the firm that they're working with, they want to do some more. So really it is guidance. It's quite a new approach for us here at the SRA to put our guidance in this sort of form, and we regard it as very much a live, living document which we will be seeking to review and also to put out more guidance in due course. What we want to do is have a look at the sorts of reports and qualifications that we do receive in once the rules are live, and hence the 6 months down the line we're starting to get the reports in. We'll be looking at those submissions and providing feedback because we're keen to ensure that accountants have comfort that they're reporting in the right sorts of things and that the receipts that we get in are in line with our expectations. So this is just the start from our perspective, and we'll be continuing to engage with both the accountancy profession and representatives of the bodies as we move forward with it to make sure that everybody's comfortable with the changes that we've put in place. Okay, so we are now going to have another vote when the voting button should appear hopefully on your screen shortly. And what we're asking you to consider with this next vote is how we at the SRA can go about making accounts-related information more accessible to you all as users of this. So we'd like us to give you consider whether you think it would be helpful to have an area on the SRA website where there is gathered together all the information around accounts rules, guidance, the actual rules, etc. Or indeed whether or not you're happy with the website as it's currently structured, whether you think that you can currently find everything that you need. So
we'll open the vote now and give us your views. I think the SRA website's got a lot better. I use it myself. The search function seems to work well, and it might be sufficient enough for people to get the information they need, or you might well want a dedicated area. We'll listen to your views and see what you say. So
okay.
So we close that vote off?
Yeah, we'll close it off now.
Oh.
100% driving.
100%. So we need to get working to make sure we've got a dedicated section for accounts rules and the reporting accounts, and I think we think that's a good idea, and I think that gives us a bit of a mandate for us to move things on internally.
We have consensus
within
the audience on this.
I never expected that.
Okay. So Sean, you're up next.
Okay, so just waiting for the slides to refresh there, but I'd like to just talk about the next phase of the review, phase 3, which will be looking at the SRA accounts rules as a whole. This will include a recognition of the regulatory burden that holding client money places on firms. Work has already begun on this process, and we intend to consult in the spring of 2016 with any changes coming into effect sometime after April the following year. Whilst the protection of client money remains a key SRA objective, the current SRA accounts rules contain a large amount of technical detail and, as Amanda has already said, were not amended to an outcomes-focused approach at the time of the introduction of the current handbook. We agree with feedback from stakeholders that the rules are overly prescriptive, and our experience from receiving accountants' reports is that this leads to a focus on minor technical breaches rather than on client protection. For example, there are very detailed provisions and timeframes for separation of mixed payments which do not reflect the modern reality of internet banking, and which are really just examples of the general principle of keeping client money and other money separate. So that's Rule 17 if you want for your numbers. The definitions of client money and office money are complex without being exhaustive, and the current structure of the rules makes them very difficult to follow, and they often repeat each other at different stages. Our intention is to move to a more principles-based approach that concentrates on risks to clients' money. We're aware that some firms, including smaller firms, find that a certain level of detail assists in compliance, and we will be developing a toolkit in support of the new approach for those that require further guidance and support. We have recently replaced the provisions in Part 7 of the accounts rules relating to client money held in overseas practices with a set of simplified principles now contained in the overseas rules. Whilst the context is different because the overseas rules need to be broad enough to work across a number of jurisdictions, these changes provide a useful illustration of our direction of travel. Our discussions with COFers have often indicated uncertainty over the role and fears that it is overly systems-based rather than focusing on real risks. So that review is well underway, and we'll no doubt we would welcome your input on that as well. So I'm just waiting for the slide to come up with our final question of the day before we start to answer your questions. The question is, when it comes on your screen, would you like a toolkit alongside the guidance that we have at present? Do you think that will be useful for you in knowing about the changes to the rules and helping you to implement these new procedures? So if we open the voting, and never know, open for another 100%, fingers crossed. Although Amanda and I might have to do the toolkit, so more work. Okay, so
people
I think hopefully that's enough time.
Right, so we'll close that off now, and let's see. Ooh,
oh,
very nearly 100%. So, according to our information here, 95 to 97.9% of you have voted yes, you would find toolkit helpful, and 2 to 2 points.
Oh, it's 97.9%.
Sorry.
Yes.
It's a number of people. Sorry, misreading the screen here.
2 people. That wasn't Amanda and I who said no.
You should have clicked on that, shouldn't you?
Yeah.
But 2.1% of you have said that no, you wouldn't find toolkit helpful, but everybody else apparently would do. So,
so that is something again we will take back, and we will try and develop some kind of toolkit to enable you to implement these changes. I think this was something that was discussed at the Colton Coffer conference yesterday. Maybe something that might be more bespoke for smaller firms or medium-sized firms or multidisciplinary practices as well. So that's very useful. Thank you. So now we're going to take a short break and collate your questions. So just be a couple of minutes. We'll come back and then answer your questions. So please bear with us, and we'll be back shortly. So welcome back, everyone. I think well, thank you. First of all, thank you for your questions. We've got quite a few coming there, and we will hopefully get around to answering all of them if we can. If we can't, we can always try and add to our FAQs document, which is, I'd say, going on the website sometime next week.
Okay, so here's a question which I think I'm going to send your way, Sean.
Okay.
And the question is, what does qualified mean to the SRA?
Okay, so qualified accountants reports are one of many sources of information that we receive and help us build a risk profile of a firm. As we noted in the slides, a lot of the qualified reports we currently receive detail only minor breaches and don't really assist us in building up a picture of what's going on at the firm. You know, if you've seen a lot of qualifications for office money held in client account for longer than 14 days, for example. We hope that future qualified reports will be more beneficial to us in providing relevant data about when there will be a real risk to client money, and then we can use our regulatory powers appropriately to act upon that if necessary. Hopefully that answers the question there. So I've got one for you now, Amanda. You've asked accountants to qualify on material breaches or systems and control weaknesses, but you haven't defined what materiality is. How are we supposed to work that out without your definitively stating what it is?
Oh, well, our rules have always required qualification for material breaches. However, in practice, many accountants qualified reports for trivial breaches where the safety of client money was never likely to be at risk. But, you know, as we all know, materiality is a difficult area because it has to be judged in the specific context of the firm under review. So, in the guidance, we've set out circumstances that we believe would usually be material. So, for example, an unreplaced shortage on client accounts. And just to reiterate, that guidance will be, it's not available just at the moment on the link that was on the slides there, but it will be available certainly by the end of next week. So please do go back to it and it will be available then. So a material systems breach, that might be where, for example, reconciliations aren't carried out, or where there are differences on reconciliations which are never addressed, which of course renders the reconciliation worthless as a control. So I think really in summary, at the end of the day, we're asking reporting accountants to use their professional judgment because we're no longer requiring the use of the reporting accountant's checklist, which of course details standardised test procedures for each firm. We'll be monitoring the receipt of reports for the few months after receipt, and we'll issue further guidance where we see the qualifications are being made that relate to trivial breaches. Of course, again, it's difficult because the pattern of trivial breaches could represent a material system failure, so we're going to be relying on the reporting accountant to make that clear in their reporting to us.
Good answer.
Right, okay, so here's a question now for you, Sean, and this is about whistleblowing. So are the accountant's whistleblowing powers affected by the changes?
No, that's a really important channel for us to get information from accountants where there are serious issues before they submit reports, i.e. when they become aware of problems. We still expect reporting accountants to report matters of serious concern to us as soon as they become aware of them. So there may be things like a fraud or where a retainer is due to be terminated due to a potential qualification. So you can report matters to us on a named or an anonymous basis, and the email address to do that is reports@sra.org.uk. So we would welcome any reports under those powers. Okay, so I guess this is a question about the mechanics Amanda. So we've got a question here that says, who should submit a report and when should that be submitted?
Okay, so it's the law firm's responsibility to submit a report, whether a qualified report or a cease-to-hold report. We considered, as part of the consultation, whether accountants should be required to submit, but we decided that as it's the law firms that we regulate, that the law firms should continue to bear the responsibility for submission. And of course, law firms should be submitting a report if it's qualified or if the report is a cease-to-hold report, and that of course is whether it's qualified or not. And the report is still required within 6 months of the period end unless you have an extension or you have a condition which requires you to submit a report more frequently. We've got another question which sort of relates to this, which is about who decides whether the firm is exempt from submission
exemption to have an accountant's report.
Okay.
Yeah.
So we've got a question about who decides. So is it the firm or the reporting accountant that decides, and it's the firm that decides?
Yes, definitely.
So for the firm each year to decide whether or not it meets those exemption criteria, and if it is exempt, then it doesn't have to commission the report at all. Although, of course, in the previous consultation, many firms said that they would want to have an accountant's report, even if there was no requirement to do so. That remains the case, and you can be exempt but still decide that there's value in having a report. But that's for the firm to determine.
The only thing I'd add to that as well is if it is the duty of the firm to make that calculation, I would just ensure that you document fully what you did in making the calculation, which figures you used, which reconciliation figures were used, and how those averages were calculated, as well as what the maximum balances were at each of the days.
Okay, so I've got a question here about timing. So the question is, my firm has a year end of 30th of November 2015. Would my accountant need to use new forms? Sean?
So yes, you would. As the year end is after 1st of November this year, the Phase 2 changes will apply. And if the report is qualified, it needs to be submitted to us by 31st of May, if my calculations are correct, 2016, which is 6 months after the year end. And it's important to note here that all reports need to be retained for a minimum period of 6 years. So whether they're qualified or not, they need to be retained by you, the firm, and that enables you to demonstrate to us that you have had a report commissioned when you were supposed to do so. Which kind of brings us on to the next question that I've got for you, Amanda, actually. And it's something that I suppose it's crucial when it comes to a question of trust, I guess. How do you know that qualified reports, how does the SRA know that qualified reports have been submitted by the firm?
Well, that is an excellent question. And it's one that we faced a number of times during the consultation period, which we've given close consideration to when making the changes, both here for this Phase 2, but also, of course, for the Phase 1. And what we came down to was that it's a professional requirement on the part of solicitors for a qualified report to be submitted to us, and so we have to trust that a firm would submit to us. Although, of course, there are disciplinary consequences for firms where we become aware that they haven't submitted a qualified report to us. We also had regard to checks and balances that we have in place across our regulatory framework, such as if a firm is subject to a forensic investigation, we would look at, we would ask to see the accountant's report for that firm. So if a firm wasn't able to show that they had had a report done at all, or that they hadn't submitted a qualified one to us, we would then take further action on the basis of that. Also, when we're engaging, perhaps through our supervision function with a firm, we may ask to see accountants' reports as part of that engagement. And again, reminding the point that Sean just raised, that reports must be kept for 6 years. And of course, the whistleblowing provisions for accountants to report serious breaches to us still apply. Okay, so another question we have here is again one that we heard through the consultation, and that question is essentially, why change the reporting accountants regime before making the changes in phase 3 to the accounts rules?
It's a good question, a fair question, and I understand why people are asking that. We recognise that the accounts rules needed to be reviewed. I think any set of rules that has a section dealing with computerisation probably needs updating. We initially explored whether reporting accountants' work was necessary and proportionate, and we concluded that it was. Having decided it was, we wanted to move ahead and make the regime fit for purpose. We wanted to do something, I think, sooner rather than later, and we felt it was best to do one thing rather than everything at the same time, and hence we adopted a phased approach, which we felt would enable us to move towards our objective of reducing regulatory burden earlier than otherwise would have been possible. We know it's not ideal as the accounts rules are still largely unchanged, but we hope these changes will help firms get more value from their reporting accountants, and also remove a large number from the requirement to have any report at all. We recognise that the new regime will need to be tweaked when the rules are reviewed, but we don't expect any significant further changes to the accountant's work. Hopefully that answers that one. We know it's not ideal, but I think we have moved on, and we're getting towards a good place there. So, one for you, Amanda. My firm has a general client account and various designated deposit accounts. How do I work out whether or not I'm exempt from the criteria to have an accountant's report?
Okay, so you need to take the total of all client account balances at your reconciliation date, and for each reconciliation date, compare the total of all of those client account balances to the £250,000 maximum limit. If you've exceeded the £250,000, you won't be exempt. But if you haven't, you would then calculate the average of the total of the balances at those reconciliation dates across the year, and if that average is less than £10,000, combined with not having a total over £250,000, then you'll be exempt. Sean and I were discussing earlier what might be the position for firms who hold foreign currency client account balances, and we think there that as long as you use a reasonable approach to translation into sterling, that might be that you translate at each reconciliation point, or that you translate perhaps at the end of the year when you're doing the calculation. We think either of those would probably be reasonable, as long as you're not, it doesn't look like you're manipulating those translation rates, then I think that would be fine. Okay, Sean, here's a question for you. This is around cease to hold. So do the SRA still need a report if the firm's closing and there are no breaches?
Yeah, I think we covered that earlier. We do require a report when a firm is ceasing to hold client money. I think this ties in with another question that we had about when a client account falls to zero, and is that a cease to hold? Well, no. A cease to hold generally happens when a firm is closing. I mean, it can happen when a firm chooses not to hold client money, but it's not when the account falls to zero, because at any point in the future, if you received a deposit into client account, then you'd effectively potentially come under the regime again. So hopefully that answers your questions. We are getting a massive amount through, which is great. So we're probably going to rush through and try and get through as many as we can here. So bear with us. This one looks like it's come from an accountant, I'm guessing. This says, one for you, Amanda, I'm giving you this one. Firms are still subject to the accounts rules. How can I be sure I scope my work properly to look at areas of risk, controls, and also cover the rules? Will the SRA seek to take action against me if I don't spot a problem?
Oh my goodness. Okay, so again, this is, as we've mentioned, we have been engaging with a variety of parties, and this is an issue that I know reporting accountants are very concerned about. And what I usually say to them is that the SRA has always had the ability to take action where it feels that reporting accountants haven't carried out their work properly. But putting that in the context of our experience over the last few years, considering that when we were still receiving all reports in, that would be about 10,000 reports every year, the number of cases where the SRA has taken action against accountants is really very small. I would say less than 10 cases a year. And those cases would only be where the accountant has clearly not done what any of us would expect that they would be doing as part of performing their work. Just bearing in mind as well that the accountant's report is intended by us as it's an additional control for the SRA over confidence around client money. And so long as we can see that the accountant has planned and scoped their work to take account of the size of the firm, the nature of the work undertaken, the size and number of transactions undertaken by the firm, and it's come up with a plan to undertake that work, it's highly unlikely that the SRA would want to take any action against an accountant. Remembering that it's the law firm that's required to comply with the accounts rules, and it's the law firm that has the obligation to report material breaches to us.
Okay, so hopefully that's answered that one. I'm trying to pick out some fairly short questions. We've only got 5 minutes to go here. So we've got a question here asked, has the reporting accountant's checklist been revised? The answer is the reporting accountant's checklist has gone. We don't require accountants to fill that in under the new proposals. It's up to the accountant themselves to design tests that are appropriate for the type of firm that they are engaged with.
Okay. I've got a question here, which is, my firm had a waiver from preparing a report because we had few transactions. Will the waiver still apply? And the answer to that is no. We've carefully reviewed the risks of holding client money, and for year ends after the 1st of November, you'll be exempt if you meet the criteria that we've already outlined, and we don't consider that we'll be needing to give waivers currently, because we have specifically identified those exemption criteria.
Okay, great. Next one, can you give a specific example of client accounts being used as a bank account? Okay, yeah, we do see this in forensic investigations, and we report on this when we see it. It's, for example, there's a property purchase and a large amount of money comes into client account to facilitate that purchase, which is ultimately aborted, and then the solicitor is asked to pay out the money on client account to various different third-party sources not connected to any legal transaction. That would be, to us, an example of client account being used as a banking facility. In that instance, what we would expect is for the money to be returned to the client who provided that deposit into client's account. Okay. So, yeah, Amanda, you answer this one. It is better if you explain with an example how to calculate the maximum £250,000 threshold. Is it on a monthly average basis?
What you'll see when you look at the guidance is that essentially, rather than have to go through every single bank statement and see whether you've had a £250,000 transaction, we're going to ask you to look at the totals, your reconciliation points. So whether you reconcile on a daily basis, weekly basis, or monthly basis, those will be the figures that we'll be looking at, because we recognise that we need to make it practical for you all to do these calculations.
Okay, good answer. Unfortunately, it looks like our time is almost up now. It's some really good questions here, and we'd like to try and, as I say, capture some on FAQs, or perhaps we could even respond to individuals, because we've got some email addresses here, because it would be useful to do that. The guidance will be on our website shortly, and hopefully we'll be able to get copies of the slides on the website as well. I'm sure that, as Amanda mentioned, you will be able to download this recording on demand sometime later this week. Otherwise, I think we'd like to thank you for participating today and your input and your votes. We hope it's been useful, and we'd welcome your feedback if you could complete the exit questionnaire as we log off here today. And we hope you find the changes useful and are able to implement them fully.
Thanks very much, everybody.
Thank you. Bye now.
Bye-bye.